I've been using a trading strategy for the last 6 months, and the beep finally hit the fan. I am going to take you on a journey that started 6 months ago. This could be one of the most important videos that I record. It could be called game planning. It could be called adjusting. It could be called confirmation. It could be called dodging bullets. All of those themes are going to be playing out in this video. Let me take you back 6 months ago and give you the market backdrop, because what's really important as traders is that the market dictates everything that we do, all the strategies that we implement. And as we're devising our game plan, we continually monitor price action and we watch for shifts in supply and demand. Our finger is on the pulse constantly. Back here, we had this deep market sell-off. Didn't look good. This is a 20% sell-off. Came very quickly. Market could have easily put in a double top lower high and it could have rolled over. Well, we finally got this nice little bounce. We retested the major moving averages, and now the market's starting to drift higher. We've got tiny compressed candles in here, and oh, there we go. We've got a new all-time high. Well, by the time we bounce off the major moving averages, I'm reluctantly bullish, okay? I don't like what I see. I don't like the macro backdrop, but we don't trade what we think or hear. We trade what we see. And as the market started to creep higher, okay, now we've got confirmation. The strategy that I've been employing is to sell out of the money bullish put spreads on really strong stocks, distance myself from the action, knowing that at any time the market could dip in here. Well, consistent with a market that's trending like this and going higher, those dips should be brief and shallow. Here we got our first little dip. Was it brief and shallow? Yes. Confirmation. This long red candle right here that touches AVWAP-Q is instantly erased by another long green candle. My best opportunities are going to come when I've got these little bid checks, as they're called, and this should lead to the next leg higher. Yes, it does, but we don't get to see this part of the equation when we're trading. We have to go off of the information here, and yes, we get through this high. Now we're at a new all-time high. Okay, convincingly? Not really. Here we go. We have a gap reversal off of a new high, big down day, and follow through the next day. Could this be the drop? Well, I'm going to know if I get confirmation here, which I do. The next day, the market opens above the open of that long red candle, so that support has actually held. Here, I can get a little bit more aggressive. I can day trade from the long side. I can do some short-term overnight swing trades, take advantage of what I believe is going to be a nice leg higher in here. So I'm painting the picture of what happened. And so we're going to continue to use this strategy, but a lot of people, a lot of traders will look at this and go, well, I'm not buying that. They've been sidelined for a lot of this move. This has been one of the most hated rallies I've seen. I agree with it. I agree with that sentiment. I felt like the rug could get pulled out at any time. Tiny bodied, small candles on light volume are not something that you can really get behind, because the chance of a reversal could come at any time. And if I had to characterize the way that I felt about all this, it would be Bill Murray in Caddyshack. It was a very funny scene. He cleans the pool out, he sniffs it, and he thinks it's a Baby Ruth, so he takes a bite. Well, that's how I felt the whole way up. Hey, it's okay. It's okay. Coast is clear. Market is continuing to move higher. Continue to move forward with the strategy. It's working out well, but I know at some point in time, it's going to stop working. And that's okay, because I have a game plan, and I've been mentioning that game plan to you in my videos. Well, what's the game plan, Pete? Well, if the market gets into a really rough spot, what I'm going to do is I'm going to be looking for those opportunities to short futures to hedge all of my bullish put positions and to hedge my naked put rights. All right, now we got a nice little dip in here. You can see that the market starts to sell off. We're at AVWAP-Q. That's kind of a nice long red candle in there. This was on November 6th, and now we're testing a VWAP-Q. Okay, this could be a bit of a warning sign. And in here, I have been selling some out of the money bullish put spreads and some naked rights. So now all of a sudden I have some problems brewing, and this takes us up to November 14th. Everything's going fine, but I do have a couple of positions that are starting to give me some headaches. So I'm going to take a look at them right now with you. We'll look at timestamps. We'll look at the stocks. We'll look at how I adjusted those positions. We're going into this time period right here. I'm going to move these chat notes up and down, and then we'll go and zoom into the stock so you can see exactly what I was looking at. Right in here, you can see on November 6th, okay, I'm short S&P. I don't like what I see. I don't like the fact that the prior high has been violated. I don't like the fact that we've been floating in here. We've got negative days in here. You could already see the selling pressure. We had 3 down days. Even though the market didn't move much, you could see there was some late day selling with the market closing on its low. And now all of a sudden we've cracked down below the EMA 8 and that 674 level. I didn't like that. I'm not liking what I see, and I might need to start hedging with some futures in here. On November 6th, I did a video. I highlighted 2 stocks, APLD and BE. So here I am selling, actually I'm buying back my APLD November 21 puts for $1.38. I just put that on, so it's a tiny loss. But anyway, let's take a look at APLD. Again, I sold the Nov 21 puts, and these are way out of the money for $1.38. And let's take a look at APLD as the first stock. And this was up in here in November. So we had this compression in here. And I really liked the fact that the stock had been rallying like mad. It had come back and it was finding support right here at the breakout. So that's your breakout right there, and that has become support, and the stock has been able to tread water. Well, these options were priced so high that I believe with the stock at $35, I was able to sell the $28 puts that expired in a week or two for $1.28. So $28 puts. Those are $7, $8 out of the money, and I'm going to get $1.30 for those. That means that I'm going to be buying the stock all the way down at the 50-day moving average, way down in here. And I've only got to wait a couple of weeks, and that strategy would have returned somewhere in the 8 to 10% range. Mind you, I've been doing this for 4 or 5 months. I've been generating great income like this the whole time. It's just a matter of when the shit hits the fan, am I going to know what to do? Am I going to be able to react fast enough to close everything down? I'm already sensing, based on what the market was doing in here, I didn't want to see this type of follow through. I certainly didn't want to see that type of selling. I didn't mind a little bid check. Let's check that breakout right in here at the 674 level, and then let's fly off of it. That's what I'm looking for. And whenever you devise a game plan, this happens before you even put the trade on. So many times I see traders and they're like baffled. They don't know what to do. Well, what was your game plan? Well, I was kind of thinking, if it went higher, then I might take profits here. Well, where was your stop? Well, I didn't really have one. I just kind of, You have to know exactly what you're going to do on the way in. What do you think the market's going to do? What don't you think the market's going to do? What do you think the stock's going to do? What don't you think the stock is going to do? If everything's going fine, you stick with the position. If conditions start to change, you have to get out. You have to adjust. I put the trade on. I didn't like what was forming. So I thought, you know what? I'm going to take a small little loss on this and I'm going to close that trade down. So I sold it I bought them back for $1.38. I had sold them for $1.28. I'm already sensing that I don't like the way things are shaping up right here. Plus, we had just gone into a government shutdown. That's not particularly good. And now it's already lasted a week. Maybe it's only going to last a couple of weeks. This is typical. We've seen it so many times. So the market was going to discount the shutdown. But in any event, we weren't getting any economic news either. So there was no jobs report. There's no economic news. We didn't really know how the economy was doing. We only knew that it was starting to deteriorate heading into October. You can see here that I am short Microsoft, and the reason that I was short Microsoft was because I had a Microsoft bullish put spread on. And let's take a look at what we were doing there. So earnings came out in here. Microsoft, everybody likes Microsoft, right? Into year end, seasonal strength. Yeah, that's not going to be a problem. Microsoft's not going to be a problem. So while all this is going on, I'm looking at Microsoft post earnings and it's still floating here above the 50-day moving average. So I thought, well, typically I'm not going to do a trade right after earnings. I'd like to see 5 or 6 days worth of price action so that I can determine if the move is legitimate. But I felt pretty comfortable selling a bullish put spread expiring November 21st. I sold the 510 puts and I bought the 505 puts. And I did that for a credit of $1. Very typical for me. 5-point spread between the strike prices. I want a $1 credit for it. I want to stay inside of that 3-week window. And I'd sold it in here. So I had 3 weeks until expiration. Stock should find support at these major moving averages, right? I mean, it's Microsoft. Look, we got horizontal support. We got the 100-day moving average in there. We got the 50-day moving average. I'm below all that, right? So you can see that SMA was at 511 in here. I'm selling it below the 100-day moving average. It's Microsoft, right? They like the initial news on it, so I thought it's not going to be a problem. Well, it broke down through that support, and once it started to break through these major moving averages, I knew I had a problem. So the way that we set up these bullish put spreads is that we always want to make sure that we've got multiple levels of support between the current stock price and the short strike price, because those levels of support should hold and they're going to increase our odds of making that credit, having a successful trade. When those support levels fail, all of a sudden the character of the trade has changed. A support level that should have held failed. And so now Microsoft is starting to sell off. Well, I've got 2 choices. I can either leg out of the spread, and legging out of a bullish put spread by buying back your short strike price. Now I'm just naked long 505 puts. I didn't want to do that. And the option bid-ask spreads were a mile flippin' wide. What I chose to do instead was I was going to trade the underlying stock and I was going to leave the spread on because I need some temporary relief here. I need to hedge myself on that Microsoft trade. So I'm going to try and make a little bit of money while Microsoft is breaking down below the 100-day moving average. Now I've had my first shot across the bow. There's a problem. I also shorted ES. Didn't like what I was seeing. This is a time to start hedging some of my other bullish put spreads. LMT. Oh, nuts. I got another problem here. I had an LMT bullish put spread on that I had put on weeks before. It's LMT. It's a defense contractor. This stock has done a whole lot of nothing. So this shouldn't be a problem. So right in here, we had this compression. And I felt that LMT post earnings, stock pulled back a little bit. Look at that strength. I'm going to lean into that strength that tells me that long-term buyers have been there. Not a problem. So in this particular instance, I sold the 480, 475 bullish put spread for $1 credit. And I was well below this 50-day moving average. This prior resistance, now support. Stock holding that support level and that support level. So I felt comfortable being in that bullish put spread. Well, now what happens? Well, the stock breaks down through support. Oh, crap. Again, and this is very common. If you're an option trader, what you'll find is that when the stock starts to move, you got nice tight bid-ask spreads. And then as soon as the stock starts to move, the market makers, which is all automated, they widen out the bid-ask spread and they jack up the implied volatilities. So if you had a 20-point bid-ask spread on an option, you're going to have a 40 or 50-point wide bid-ask spread on an option. It makes it extremely difficult to trade. The other thing is that they don't budge. They don't trade in the middle. LMT is not the most liquid option either. So it's not like there's a lot of retail paper to be on the other side of me. When you decide it's time to get out, you can't rely on retail paper being there to take the other side of your trade so that you can middle it. You're pretty much always trading against the market makers. And that's one of the big disadvantages of trading options. And at any time, the market makers can just flip the switch and jack up the implied volatilities. It's all done automated too, and widen out the bid-ask spread. That increases their odds. What they're saying is, I'm not interested. I don't want to trade that. If you want to trade it, we're going to make it very difficult and very expensive for you to trade it. Again, what was my initial game plan? I'm going to short futures. By shorting futures, I'm going to be able to take advantage of the market drop. I'm going to make money there, and the money that I make on my futures trades will at least offset my losses on that spread, and probably then some. I can also short the stock. I don't have to leg out of the spread if I don't want to. If the bid-ask spread on the options is nice and tight, fine. I can choose to buy back the short leg and then let the stock come in, and then I can exit my long leg. So yes, I certainly can take advantage of that. There's a lot of risk in legging out. And mind you that I'm trading short-term options. Time premium decay that was working for me because I was short a closer to the money option is now working against me because I am long a option that's going to expire in a week or two, and that time premium decay will be working against me. So best thing I felt I could do in this situation is just short the stock. Okay, it's broken down. You're going to have plenty of opportunities here, and who knows? Maybe LMT bounces right back and the spread expires worthless. I've had that happen a ton of times. And the market right now is not that bad. I mean, things aren't falling apart right now. This is on November 5th when the stock cracked down. On the 6th, that was right in here. So I've already had a big drop and a close on the low below the 50-day moving average. This stock is going to test the 100-day and 200-day moving averages. What happened? Was there some news? No, there really wasn't anything to push the stock down, just people wanting to get out of the dang stock. I'm short futures, I'm short Microsoft, I'm short LMT. So here I exit my short position on Microsoft. I made $2.55 shorting the stock. I sold the spread for $1.35. So right now I've kind of locked in a loss of $1.10. It won't be any worse than that. So here I exit the short position. There's a 23-point gain on my futures. Nice. LMT, I exit my short. That was in the afternoon. I made $2.01. I also had shorted it the previous day. In all told, I'm not in bad shape on it. So I've got $3.24. I did it for $1 credit, $4.24. Now my risk on that is down to 75 cents on that spread. And I just made some money on futures. So everything is looking pretty good at this time. And if I get that market bounce, we're still going to be in really good shape. BE, I did a video, said I love BE. This stock has been so dang strong. On November 7th, I sold the BE 116 puts for $5.90. That means that I would be net buying the stock around $111. I think the stock was at $140 at the time. Yeah, I'm all over that. And at this stage, you can see November 7th, November 21st, 2 weeks. In 2 weeks, I can make about a 10% return based on holding half of the strike price in reserve. Let's take a look at where it was on November 7th and November 12th, because I bought those back and I bought them back at $5.80. I made a dime on it. Big whoopee, I made a dime on it. The more important part was I didn't like what I was seeing. And here we can see November 7th, and there is November 10th. So the market's bouncing off of the 50-day moving average and AVWAP-Q. Nice, with a bullish hammer This is awesome. I like this. This is when I think I highlighted BE as well in my YouTube video and said, hey, I like selling these out of the money puts. We see the market heading higher. I want to see that this was the extent of the selling. I want to see that buyers are aggressive. If I don't see that, then I know that I've got problems, because then we would have a lower high double top. That would tell me that the market is going to probe even deeper before it finds support. But for right now, everything's still looking pretty good. So we've got BE on the 7th, and you can see how nice and strong the stock has been. Stock gapped up. Look at the strength in this stock. There are long-term buyers in this stock. But all of a sudden, I start seeing the stock losing its bid in here. And so I bought those back on November 12th. I had already seen also that there was some rotation out of some of the high flyers. So a lot of the AI stocks were getting their wings clipped for sure. And I thought, I'm not getting the feeling that I need to have right now that the market rally is going to continue. I didn't get these nice big stacked green candles. Yeah, we bounced off the 50-day moving average. Everything was seeming okay, but this is kind of better for me to reduce my risk right now. You can see when I put that on, the high for the day was $146. I would have to buy the stock at $111. That would be my net cost. Okay, so we are $36 out of the money. This stock could fall dramatically. It could lose almost 30% of its value in 2 weeks, and I would still be okay. I will take those odds all day long, but I have to be aware of changing conditions. I saw them changing, and I ended up buying back those puts. Good decision, because look what the stock did the next day and the next day. Now we're down to the 50-day moving average, and we're trading around $100, okay? Still wouldn't have been the end of the world, because this stock carries a lot of option implied volatility. If I were assigned, I could have sold some calls against it, but I wouldn't have been assigned at that point because I sold the November 21st expiration. So I would have still had the position on. November 14th, let's go into that chart. Now, all of a sudden, this little rally and the bounce that we wanted to see, and we wanted to at minimum get up to the previous high, we didn't have that. We needed buyers to step up. And when they didn't, this was a sign that we could have a double top, lower high. We had a long red candle in here. This is on November 13th. I did not like that at all. That was a heavy day of selling. So after the close that day, I decided I was going to watch the overnight market, and I've got some risk exposure because I've got some spreads on right now. Am I going to need to hedge with futures overnight? That's what happened. This was actually on the 13th, and it was at 5 o'clock Central Time. I shorted the futures at 67.20. This is what the SPY did. So this is the after hours gap down. Uh-oh. Now we're right on the 50-day moving average. Okay, we'd already had this long red candle, and now in after hours, we're already testing that 50-day moving average. That is not a good sign. Market pulls back, and you can see how we've got this drift lower. These are mixed overlapping candles. What does that tell us? That tells us that yes, the trend is lower, but this is not a very strong move. So I'm not going to short futures in here, especially not after hours when they're fairly illiquid. What I'd like to see is I'd like to see a failed bounce. Bingo. There's my long green candle. So I want to see that candle preserved. Ideally, we stack another one on top of it and we fill this gap in after hours. As someone who has bullish positions, that's what I would like to see. We see this candle preserved, and then we try and get through the high of that long green candle. Nothing going whap. Uh-oh, I don't like this long red candle here at all, because now I have confirmation that this was a solo. This was just a program out there testing to ask, how big is the offer? How aggressive are the sellers? If they could move the market and get through that, then the programs would keep going and they'd know that this is just a short-term little sell-off. But when the ask got replenished, they didn't just cover their long from here. they sold that position and they started to add to their shorts because now they had confirmation that there was a big ask out there, that the selling pressure was heavy. So when the open of this long green candle failed, I had the information that I needed to take a short position. I was in there, we were within striking distance of the 50-day moving average, and then we stacked 3 long red candles with the 50-day moving average being breached. That confirmation right in here with that breakdown and that long red candle that erased that green candle and the sell-off and the selling pressure that we had seen the prior day, all of that information had to be taken into consideration. And I felt that my odds were good on making money on the short, but more importantly, I had some long positions I needed to hedge. So I'm short here, and then the next morning, I ended up buying back my futures position, and I made 40 points on it. Fantastic. More than offset what I thought would be any losses that I would take that next day. On the open, November 14th, we come in, and I still have GLW on. And I'm going to take you through the 14th. And the 14th, you can see here on this chart, market sold off below the 50-day moving average, and it bounced. Okay, well, I don't know that going into the day. I come in, and I do have one remaining position on in GLW. So that was my only spread that I had on. I did have some naked put rights on, but I was fine with those. I was fine with taking those stock positions, and they had a November 21st expiration. So no issue there. I had November 21st bullish put spreads on as well. So I've still got quite a few positions on. GLW was one that I had to worry about because these options were going to expire that day. And the spread that I had on was I sold the 84 puts and I bought the 82 puts, and I did that for a 40-cent credit. And everything is looking beautiful. My God, what a great trade, Pete. Awesome pick. Why did you do that trade, Pete? Well, look at how strong this stock has been. The earnings reaction was excellent. The stock was able to hold up beautifully. These options didn't trade at a big premium. And there you can see, whoa. And this is when you run into the biggest problems, is when you have a bullish put spread on and you've got big movement the day before they expire. You know, from a psychological standpoint, you've been waiting 3-4 weeks for this spread to expire worthless. And time ticks away very, very slowly. And so you're finally at a juncture where you're going to make some damn money on this thing. Well, I was leaning on that 50-day moving average, and you can see that the 50-day moving average was at $83. It's like, oh my gosh, this thing just dipped into the money by $1. All I had to do was to get through this stinking day. I hedged myself overnight. Everything's going to be fine. All it has to do is rally $1 on Friday. That should happen, right? The day's unfolding, the market sells off, and it spends the day rallying off of the low. So I'm thinking, you know, GLW has been one of the stronger stocks. It should rebound. So I didn't do anything with it initially, and I kept waiting for the bounce that never came. At the close of the day, and we're going to take a closer look at this one. Bought the GLW No 1484 puts, bought them back for $1.40, sold the spread for 40 cents initially. I'm out $1. Not a good trade. I'm not happy. Everything was looking good the day before, and now it just turned to crap. That's what I'm thinking. I don't even look at the money I made on the future side, but yeah, I would have more than offset it. I always look at trades individually. Here's the interesting thing, and this was at 224 when I finally reeled those puts back in. The market maker firms know what's going on with GLW. Stock was at $82.40. Okay, $82.40. I'm long the $82 puts. Right before the close, I didn't have this trade posted, but I did do the trade. I'm going to show you what happened. I didn't have time to because here we are in the last half hour of trading on expiration Friday. I could see that the options were nickel bid offered at 40 cents. These options, they're 40 cents out of the money. Market makers, they don't like buying premium when you're in the last 45 minutes of that option's life. So I thought, well, you know what? I'm going to put a dime offer out there. Volume was very low, so I knew there wasn't any retail paper in this. It was just the market maker. Will the market maker take me out for a dime? I need to get at least a dime. I'd rather have it expire worthless than to sell it for pennies. Okay, I need at least a dime for this thing. Dang it. Everything's already gone to shit on it. So I'm going to put the offer out there. They ripped me out instantly. A dime, boom. They wanted to buy those options. Well, what does that tell me? That tells me that the market maker firm feels that there's a good chance, and they are all knowing and all seeing. They see all the order flow, and their algorithms evaluate that. What it told me was these guys are willing to pay a dime for something that's 40 cents out of the money. They feel that there's a pretty good likelihood that this stock can go below $82. What did I do? I took a look at the stock and I shorted it. This is going to help you. I have another instance that I'm going to show you in the next video that I do. And we're going to take a look at the stock and how it traded on November 14th. This is what foiled me. I wasn't paying attention to GLW. I got a lot of stuff going on during the day apart from even trading. So sometimes it's like I catch glimpses of stock positions here and there. There's no excuses. I should have set alerts, should have been more diligent with it. I wasn't. But this steady selling pressure was definitely a clue that I was going to be in trouble. But here we go Friday, we open lower, and then look, the stock is right up at $84. And I'm like, all right, well, I should have taken care of this the day previously. And then I get the bounce, and I'm like, it's going to rally above $84. I'm not going to worry about it. I should have bought them back, but they had spread the option bid-ask out so wide that the options were super expensive. I was like, if I just wait another 2-3 hours, these things are going to expire worthless. And the stock and the market had actually been moving up off of the 50-day moving averages. This is the second test of it. I don't feel that threatened by it. I wake up and I go, oh, crap. This stock is starting to sell off. Well, I don't wake up until like an hour before the close, and I look at my portfolio and I'm like, oh, I got to do something with these puts. I got to buy them back in because I don't want to take assignment of this stock. So I bought my puts back, and then this is where the stock was when I ended up shorting it. And you can see the stock is somewhere around 82.50 right in here, right around VWAP. This is nice steady selling pressure. After a day of steady selling pressure, the market makers think there's a chance for this stock to close below $82. I'm going to take a short position here. So I did. I shorted it, I think it was around 82.50. And ended up making 45 cents on it. I didn't ride it all the way down to where it closed at 81.80, but I was able to make 45 cents on it. And the point of this little lesson right in here is that if you're in a similar situation where you see market makers really reaching for an option and you're in the last couple of hours of trading, there's a good chance that they feel that that option is going to be in play. And they will, when they buy air, as I like to call it, options that should expire worthless, it's a tell. Go out there and short some stock because they know what's going on. They know what the order flow is. They know what the probability is. I'm going to lean on that information if I can. This whole scenario that I've just played out for you, this was the first shot that was fired. So I'm already kind of working my way around. I've got a lot of positions on. I'm okay. I'm hedging. I'm actually making money there. The point to this video, first of all, you have to have a game plan. And my longer term game plan all along in here was to make money swing trading because the intraday ranges had collapsed. Very difficult day trading conditions. Yeah, there were some days when it was really nice activity. We had the AI stocks were really hot. There was some sector rotation that we could take advantage of. So it wasn't like we weren't finding any day trading opportunities, but there were some days when it was just absolutely dead quiet, especially when you get into the summer doldrums of late July throughout August, early September, nothing going on. So you have to have some swing trades on. Going to generate really nice income. Market is going to keep doing what it's doing. And I know that when I'm using this strategy, at some point in time, The dip is not going to be brief and shallow. So all along here, I'm making money when a lot of traders weren't able to. They weren't able to make any money day trading, weren't able to make any money swing trading, couldn't embrace the rally. And some of them, unfortunately, were even shorting in here because there's so much gloom and doom out there right now. Everybody calling for the end of the world, the sun's going to explode, credit crisis, blah, blah. Trust what you see, not what you hear. Stay true to your game plan. This has been an excellent opportunity to sell some out of the money bullish put spreads and naked puts. Great, I'm going to do it. I did do it, but I was watching on the stocks that I had done that on to see if they were starting to falter. And if they were, I was reducing risk along the way. Wait till you see the next video. That's when the shit really hit the fan. And I had to do some really quick maneuvering to work my way around it. But again, lots of lessons in here. Please give this video a thumbs up. If you're learning from this, make sure you share it with other traders. They're trying to learn this as well. You're going to be helping them out. This content is good. You can go back and verify what I'm teaching you through all of my videos. And this is an example where the strategy that I've been using for months finally faltered. And you don't often get to see the aftermath. So it's a perfect opportunity to learn. Thanks so much. Make sure that you watch for that second video. I'm going to record it real soon. See how we trade live every day and take our 14-day free trial. I won't even ask you for a credit card. Dive into the action and trade alongside of us. Your downside is that you get some great trade ideas. Your upside is unlimited because you'll learn the skills that you need to be profitable. Check out OneOption.com and see for yourself.